Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question for Bill, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. So without any additional delay, here's the host of today's program, Bill Bullington.
And back again, like it or not. Hey, there's a lot of good things, interesting things happening in this stock market. Actually, it was one of the quieter weeks of the year. But out of that quiet week, a couple of trends have emerged. Not sure if those trends will stay trends, because you just can't know that in advance. But when you see companies whose sales and profits are rising and their share prices are going up, that's a good sign. Now, they don't go straight up, by the way. It's actually up and down, up and down. Still looking for that mythical steady stock I keep hearing people talk about. You know, the one that just goes up and then never goes down, just stays flat and then goes up again. Yeah, that that really doesn't happen. Even when you put it inside of a indexed annuity, it doesn't happen. But I'm not even going to bother talking about that. I will tell you this. If you have annuities and you're wondering, are you getting a good deal? Feel free to call us or email us on the website. We'll be glad to look up your annuity product and show you what kind of expenses you're paying and whether or not it's a good deal. Some of them are good deals. It's just like anything else. You have some really good deals out there and some not so good. So if you've got a product and you want us to take a look at it, we'll be glad to do that. I can tell you what your expense ratios are and whether or not you actually are getting a good deal. So again, feel free. You can reach out to us on the internet. I've got a workshop coming up, and we did want to talk about that a little bit. And by the way, if you have questions today, you can call us 216-901-0945, 216-901-0945. If I'm talking a little funny, it's because I've had a lot of dental work done over the past week. But again, feel free to call us in here, ask any questions you got. We've got this workshop coming up here, and it's on the 12th of January. That's sneaking up on us. In fact, I'm going to pull it up really quickly because it's going to be in two parts, actually. We've done this before, but this is and I think it's something that we'll probably continue doing for a while. Two-part seminar. So the first part starts at 6:30. And in that, we're going to be talking about individual stocks. The second part, we're going to talk about the new year, the new president, the new risks and opportunities being presented, and where we see opportunities in kind of a more traditional type of meeting. There are lots of things that could happen, lots of things that have been talked about happening, and we'll actually show you how you can track some of that stuff, paying attention to it, because it can have an impact on you. More often than not, the impacts are a surprise, but at least if you're out there watching and being aware, just watching how things develop, then it becomes not so mysterious. So we're going to spend some time looking at that during what do we see happening? What is the new administration talking about doing? What kinds of actions are they taking? What kind of risks that poses, and what kind of opportunities that may unlock? And lots of opportunities, folks. I mean, it's enormous, the amount of innovation that is going on right now. I was just looking at an ad I got as a gift, as a Christmas gift. Thank you very much, by the way. Was a Amazon the Fire. It's a tablet, kind of like an iPad. And I open it up, and it takes me to an ad, and the ad goes right to the new car coming out from Toyota this year, are being introduced in the United States. They've actually been in Japan for a while. And this car is a hybrid car. And so, in other words, it generates its own electricity and then it runs on electricity. And they're calling it a fuel cell. You actually fill it with hydrogen. It's it takes 5 minutes to fill it. You go 300 miles. And the byproduct is heat and water. There's no pollution. And because it's using hydrogen, the most abundant element in the universe, it's very interesting. Right now, they're actually getting the hydrogen from methane, which is natural gas. So, and hang on with me for a minute. Actually, I'll take it back. I'm going to show you what kind of impacts that has the potential to have on natural gas prices, on oil and gas. There are tons of things, tons of other reactions to this that could benefit us as well. It actually could benefit a lot of countries across the world. But this is relatively new. They're bringing it out in a big way, and I'm going to encourage you to get to the workshop. Kind of fun. We're going to go through all this stuff, and I'll show it to you. I'll go through the websites. I have a Bloomberg terminal. By that time, I will actually have it installed and be able to access it, so I can show you the work that they're doing. Bloomberg, by the way, has as many journalists as AP Newswire does. They've got industry analysts who are experts in their industries. They cover all the major industries in the entire world. They should. You should see how much they charge for access to their service. Yeah, it is mind-boggling. But like I said, there are a lot of really good things that are opening up. So there are tremendous opportunities. And I get calls all the time, and a lot of my clients, well, I shouldn't say a lot. Some of my clients are incredibly worried about what's going to happen, as if a president has the power of a dictator. I'm telling you this. I didn't say this in the meeting, or at least I haven't said it more than once, because the reaction was really bad. But people were really upset when I said, "Listen, you're comparing a president to a dictator." And he's not a dictator. Yeah, so I understand. He says a lot of things that ruffle feathers. He likes to do that. I'm sure he gets a thrill by doing that. But the reality is, he's still just a president. And Senate and Congress have to, and they're not going to greenlight everything he does. And a lot of things that they're talking about doing, by the way, are going to have some very positive impacts economically. Now, if they do it rationally, if they do it judicious, with my dental work, I can't even say that word, so I'm going to skip that one. Made my teeth a little longer. So anyway, there are lots of things that the president can do, but there are lots of things that he can't do. So you need to go back, review that stuff, get online, just Google it. What can the president do? How does a bill get passed? So when you look at that, you can relax a little bit. And a lot of the things that they're talking about doing, by the way, they work very well. We're going to delve into that a little bit deeper and see what kinds of people that he's put in places and where that might create opportunities, because there are opportunities. They are clear. Some of the opportunities are crystal clear. And again, but got to get to the seminar to talk about it, because I won't talk about it on the radio until after the seminar. So if you want to hear it sooner rather than later, you just go to Bullington Capital, sign up under the seminar page. It's free. There's no cost to attend, although seating is limited. We have 69 seats remaining. So anyway, back to the show. If we fast forward to today, what kind of opportunities are there right now? It is pretty fascinating. Oil prices have crept up a little bit. Too early to tell whether or not the whether the OPEC agreements are going to be adhered to this time. And if they are, that helps oil prices. And in response, you've got a whole ton of oil and gas companies that are coming up on scans that have relatively low valuations. Now, this can change. But if I'm a trader your skin, you should be getting goosebumps right now. If you're a trader, you should be getting goosebumps because you see the same things I'm looking at. Okay? The same things we're going to talk about at the first half of the workshop that starts at 6:30. 45 minutes and a break, then the second half. So this is what we're going to be talking about. And there are lots of companies coming up on scans, very low valuations, and now they got some momentum. That is the best you can ask for. In investing, that's the best you can ask for. It's not a guarantee that it's going to go higher. But when you see something that's undervalued, that's moving up quickly, you might want to pay attention. Common sense, right? This is a lot easier than so many people make it out to be. And it's 10 times easier. And I feel bad. People, they try to analyze things, first of all, are probably not going to matter much in the long run. But I think I know why they do it. Because they're looking for certainty and they're grasping at anything. They don't think they are. By the way, when you talk to them, and you know this, you've had conversations with people in your personal life in other areas where they just aren't seeing things clearly and they're grasping and clinging to the straw man in the argument, and you hold on to the straw man really hard and he kind of crumbles. So y'all know what I'm talking about. Anybody that's past the age of 20 has probably had some experience like that, and it's exactly like that in financial markets. Financial markets are actually not that complicated. They just don't work like we would like them to work. So an awful lot of people go around telling people, oh, yes, no, that guy just doesn't know what he's talking about. Sure, you can get a 10% return. I can't promise you too much, but 10% is not a problem with no risk. To do 20 or 30, no, that's out of the question. Well, let me tell you something. 10% is out of the question. You can't do 10% a year with no risk. That is never happening. Well, I shouldn't say never. It may happen again. I don't know. If you got rampant inflation and they started raising interest rates again like they did back in the 70s and early 80s, yeah, well, maybe. But the economic conditions that caused those things to happen are not present today. They're growing. The same types of pressures, inflationary pressures, are growing, but they're not to the same level that they were back when you had double-digit interest rates. And until it looks like we're there and everybody's convinced that we're there, it's probably not going to happen. You're probably not going to get really high interest rates. So they talk about, well, they're going to raise rates. How much are they going to raise them? 1%? Really? 1%? You're excited about it? That's exciting? So we've got to do some basic math here. 1% increase probably still not going to make your problems go away. It's not going to solve your problems. So you're going to have returns, unless you're just super rich, unless you own a business. By the way, that is one way of not having to worry too much about the stock market. If you own a very prosperous business that generates a ton of cash, who cares? Yeah, stick your money in 1% treasuries. Awesome. Yeah, but if you're like the average person, you're probably going to have to invest in stocks. You really don't have much of a choice. And you need to do that fairly carefully. You need to recognize the opportunities that are there. There are lots of them right now in particular. And try not to pay too much attention to the media on a day-to-day basis. You got to learn the fundamentals, find out what's important, what's not. And by the way, that is a big help. You come to the seminars, and I've talked about it a million times, and it's kind of gone over the head of an awful lot of people because I probably haven't emphasized it hard enough. But there are certain things that you absolutely want to pay attention to, and I will tell you most things you do not want to pay attention to. There are tons of things that really just aren't significant. So what are the significant things? The significant things are things like sales growth, when a company is being talked about, valuation, like how much are you paying for that business? In fact, after today's show, I'm going back to my office and we're recording a video we'll put up on the website. We're going to try to get it there before the seminar. on valuation. Basically, how do you tell what a good bargain is in a stock? And by the way, if you'd like to call in, 216-901-0945, 216-901-0945. And I'll tell you, it has more to do with the sales and the profits of a company than it does its share price. The share price is meaningless. You're looking at placing a value on a company. Don't call in and ask me the share price. I don't care what the share price is. See, the share price can be manipulated, and they typically are. If you have a share it's $10 a share, and they do a reverse 10-for-1 split, that means you're only going to get one share for every 10 shares, but they're going to combine those 10 shares together, so you get $100. Okay, so you get $100 for a $10 stock if there's a reverse split. You have fewer shares, but it's $100. Are you better off? Share price just went from $10 to $100. No, you're not better off, because for every 10 shares you had, 10 times 10 is $100. Now you only got one at $100. Works the same thing with the stock. That works the same way with the stock split. If I have a $100 stock and they split it 10 times, it's $10 a share. Did I lose $10 or did I gain anything? Nope. You're still the same. The money's the same. I'm going to take a quick call here. And like I said, if you want to call us, 216-901-0945. I'm going to go to John. You have a question for me?
Hey, morning, Bill.
Hey, how you doing?
Well, I guess you could call it a question. It's just kind of a general complaint about our tax code, with relation to IRAs.
Right.
When you sell a stock in your IRA, you get taxed on the whole amount, including your original investment. And that's
only if you take it out of the IRA. If you sell a stock and it's in the IRA and it stays in the proceeds stay in the IRA, there's no tax.
The cash stays in the IRA, there's no tax.
Right.
Yeah. Yeah. Okay, well, I still don't think it's fair. I think that they should tax it.
When you put the money in the IRA, you didn't pay federal income tax on it. Okay.
But it was money that already you did. You paid. There was this money
you got to deduct it. You got to take that off of your taxable income.
Oh.
So when you take it out, yes, you're going to pay taxes, and you should actually owe more in taxes because hopefully that money has grown over the years. And so the value is actually higher than what you contributed to it.
Yeah.
Hey, I got to take a real quick commercial break. You want to hang on?
Well, I think you kind of answered it for me.
All right. Well, have a good weekend then.
Okay, Bill.
Right, thanks. You're listening to Bill Bullington right here on 1420 The Answer. We'll be back after these messages. And we're back. Hey, if you'd like to call us, 216-901-0945, 216-901-0945. And I got Jerry on the phone. Jerry, what's up?
Good morning, William. Happy New Year to you.
Happy New Year to you.
About 6 months ago, I asked you about a local stock, and at that point it had really been getting slammed. It seems like it may be coming back now. The name of it is Fairmont Sandrell. It's an offshoot of Fairmont Sand, Fairmont Mining. It's located out east in Chardonnay. You familiar with it at all?
Nope. Do you know how much in sales they have?
I believe it's about $1 billion. It's not, it just went public about a year ago or so. And
what's the symbol?
I don't have it in front of me. I thought you may have been aware of it. It's something you may want to check out. It was just on PBS was just mentioned a week ago or so as far as potential.
What's the name of it again?
Fairmont Sandrell, Sandrol.
SAND.
Fairmont Sands is the company. They make sand for fracking and oil field services, that type of thing.
Okay.
So yeah.
Yeah, I'll take a look at it. It looks like
it's gone from about $1.50, and that was at its low point. It's up about $8 today.
Yeah, the thing that's most important to me is how much in revenue they have and whether or not they've been profitable. The and kind of the growth rate. But here I've got the investor relations. This is pretty funny because it's still not giving me the symbol. Knuckleheads. I don't even put it up on there. I would put that up clearly. Here it is. It's FMSA. Yeah.
There you go. That's it.
And I have seen that one come up on various scans. In fact, it came up not that long ago. It's come up a ton of times, actually. And it's not something that I'll have to go back and look at the underlying fundamentals and get back to you on it. But looks like it came public in 2014, around $15.
Yes.
Goes down to $1, and now it's at 11.
It's about 8 now, I believe.
Let's see. I think.
I'm glad I wasn't in the IPO, but
it's actually $11.79.
Oh wow! It has gone up.
Yeah, and the last time it came up on the scan, by the way, was $9.56, and that was at the beginning of December. So you'd have seen that on one of my scans, $9.56. You'd be up about 23% right now if you took that one. Your trailing stop, by the way, would be right around 9 right now. And so that's it's got plenty of wiggle room there from 11.79 to 9. That's a big trailing stop. So yeah, we'll see what happens.
At one point you had said it was not for the weak of heart because it was highly leveraged at that point and so forth and so on. But I just thought I'd mention that to you. It seems to have attracted some attention, and well, Lord knows where it goes from here. But anyhow, it's been a nice ride.
Yeah, nobody ever really knows, and that's the thing with stocks. You have to give up trying to forecast the future. If you're trying to forecast the future, you are done before you begin. You just don't know it. It's not necessary. What is necessary is to pay attention to what's going on right now.
Sure.
And that's and I'm preaching to the choir here. I'm saying that for the people that are listening.
And certainly don't chase it either at this point.
Actually, you know what? You can chase things. That chasing actually works very well. That's what trend following is. And I know Warren Buffett said the dumbest reason in the world to buy a stock is because it's going up. Well, you know what? There are a lot of fund managers who only focus on those stocks that have done exceptionally well. It just happens to be not his style. And because he's so big, he can't do that anyway. He's got too much money. When you have over $100 million, you are going to have an incredibly difficult time incorporating price movement into your investment strategy. You're going to have to be more value oriented. Because
let me ask you this: I have a bit of it, but if I'd be interested in getting into it a little further, would I be foolish to perhaps sell some puts against it, maybe $1 or $2 below, and if I get it, fine. If not, pick up the premium?
Well, if it crashes, you'd be foolish. If it doesn't crash, then you're a genius.
Okay. Well, at this point, in order to make it crash, I think we'd have to have a complete bomb in the oil services, wouldn't we? Over a very short period of time. Say if you sell it.
The shorter the time period, by the way, the harder it is to determine.
Well,
you say that like it's making it easier.
I don't buy puts and I don't buy calls, but I can sell calls.
By the way, I just pulled it up on Y charts. Okay.
Okay.
Revenue $529 million last 12 months.
Okay, I was wrong.
Okay.
By about
the growth rate minus 21%. This is probably why I didn't trade it. Okay. Market cap $2.6 billion.
Whoa.
So it's 5 times its annual revenue and its current. Now, the gross profit margin, that's before depreciation, interest expense, all that other stuff.
Right?
Yeah, is 14%, almost 15%. That's a gross profit margin. Yeah. That's 25%. No, that's actually not very good. That's 25% below Coca-Cola's net profit margin.
Well,
after taxes.
Coca-Cola's a hell of a company. It's a blue chip, and it's done well historically.
Actually, it's only slightly above where it was in 1998. So that's an 18-year time period. If you're happy with that, I want you as my client.
It's not the only company out there that's done the same either, though.
No, big deal. We're not interested in those.
Okay, so you would not be interested in.
Well, it always comes down to valuation, because if you wanted to trade this stock, when the Lookout for the Bull website gets up, which is probably about the same time the seminar on the 12th, then you can see exactly what I would be doing, because I'm going to tell you what I would be doing. If a stock is a trade, forget looking at the fundamentals. You will not be around long enough for them to matter. If you're going to be an investor, which is an entirely different mindset, if you're going to be an investor, then you would the number one area that you're going to have to get proficient in is valuation. And the valuation on this company, because valuations matter especially when you're looking out into the long run. If I overpay for something, like somebody like Warren Buffett didn't sell any shares back in 1998, and he's lamented over that over the years. I'm not trying to beat him up. That he knew, and he's admitted it. He in a couple cases he said, I don't know what I was thinking. So the valuations matter. What something is worth, that's what a valuation is trying to do. What would something normally be worth under normal conditions? And when you can figure that out, and then you find out that the company that you're interested in is selling for 3 or 4 times what it should be selling for, if you are an investor, you walk away. So when a company like this, in an industry like the one that they're in, is selling for 5 times its annual revenues, and the industry average is somewhere around 0.6, and the S&P's average, which includes a lot of companies like Coca-Cola who are extremely profitable, is 2, and you're coming in at 5. That's why I'm just, as an investment, I'm not interested. The valuation's too high.
Trading perhaps, but not an investment. Yes. Let me give you a couple investments, see what you think of these ones. How about Verizon today?
Verizon is really tough, and here's why. They have so many divisions. Go to their website. Look at all the things that Verizon is doing. And I got to tell you, there's a disruptor coming down for all the communications companies. That's why Time Warner is trying to merge with the I forgot who they're trying to merge with. The AT&T. The reason is because Google has purchased a boatload of FM frequency across the country. The major 50 top markets, they've got a ton of FCC licenses to transmit. They're not going to use it to do just radio. They're going to do internet, super high speed wireless internet. Okay, they will be able to deliver movies with no buffering. Radio shows like mine with no buffering. In fact, they'll be up there because you can go to the website, the iHeart right now, and we're being simulcast on iHeart.
Oh,
so you can pick that up on the internet, and everything's going to be connected to the internet, and they're using the FM radio frequency to do that. So they're going to threaten movies. They're going to make their own movies and put them up there, and you'll see a bunch of Google ad. I hope it's not like YouTube where they actually show the ad in the video, because that is extremely distracting. But
how about? I was going to say, how about Coach?
Coach Purse, hang on, I'll take a look at it.
It's currently selling about $35, and
Coach,
paying a decent dividend. It's been up in the scans a few times too.
Yeah, it's got a decent valuation. Revenue trailing 12 months, $4.5 billion. Its market cap is 9.8, so a little over 2 times. It's about right, exactly where you would expect it to be. And that's what's really interesting about the companies that are very well known and do a pretty good business. Most of the time, they'll actually be within 10 or 20% of where they should be. So the potential there is not quite as high, because they're right around the area where they should be. Now, if they can continue to grow, their growth rate year over year is only 0.7%. So that's not super exciting.
Yeah, I would expect to be better than that.
Yeah. So, I don't know. That's one of the reasons I use models, though. And I got a great model for you. I'm going to go through this in detail at the next seminar. You take the cash that the company's generating, and you divide it by the cost of the entire business, the enterprise value, because that's what
we're... Is it cash meaning the net profit?
Nope. We're talking about cash. We're going to add back depreciation and amortization. It's called EBIT, earnings before interest and taxes.
Oh,
so
okay.
Basically, we're looking at operating income.
Okay, operating income.
Yep. So you take operating income, the amount of cash, and then you divide it by the price of the entire business. That means the stock plus the debt, because if you buy the company,
okay, sure,
you're going to have to pay the debt off. And that way you can rank companies based on the same way that, actually you'll be able to look at companies the same way that some of these big private equity firms are looking at them. And then you can identify companies who may be selling at more attractive prices without having to rely on a PE ratio. PE ratio is not very reliable anymore. It hasn't been reliable for years because the earnings are fluctuating so much, and the companies are legally, they're reporting things so that they look good or bad depending on what their agenda is. And rather than having to rely on an indicator that's not working so much, it's much more difficult to mess around with your operating income. And enterprise value is easy to look up. That's the cost of the entire business. And so you're looking at it just like Warren Buffett would. He's looking at, if I buy this business, how much cash is it going to generate for me that I can reinvest? And there are some nuances in doing it that way that are not completely clear or evident when people first start thinking along these lines, like I want to buy stocks, but I want to get a good bargain. And I'm going to clear that up at the seminar and show you why it's such a good way to start looking at your stocks. And you can actually set up screens if Y-Chart's kind of expensive. I think it's around $4,000 now a year. But there's some other places that you can go and run some screens. You can go right to the SEC's website, though, when somebody talks about a stock or you see a stock that comes up that you think you might be interested in, and you don't want to be a trader, you want to be an investor. So you can go to their website, pull up their SEC filings, and you can make these calculations yourself if you want to do it. But I built a new model based on it. It's actually more conservative than my high dividend model, but it doesn't give up a whole lot in the way of returns. And that's a big deal. That's a really big deal, because the vast majority of the time, whenever I've built models and I've increased the level of safety, the return drops like a rock. Mm-hmm, mm-hmm. And so I haven't been wanting to do that. So I'm very excited to be able to bring something that's similar in concept. In fact, a lot of the dividend stocks in my dividend model will actually make it into that model. But not all of them. In fact, I increased the scope so that it includes medium-sized and smaller-sized companies, so it's not just the large ones. But
well, I have a couple more stocks. Can you give me another?
Hang on. Okay. I got to take a quick break, and we'll come back. You're listening to Bill Bullington right here on 1420 The Answer. Hey, Jerry, sorry, I just hung up. Call me back. I'll be back after these messages.
Well, I'm running down the road trying to loosen my...
And we're back. Hey, Jerry, sorry about that. I hit the wrong button.
Sure. hey, Bill. It had a run up, got all the way to 75, and then it's stepped back a little, and it's
which one is that?
65 right now. It's Colgate Palmolive.
Okay.
I don't know. At one point, it was certainly overvalued. I'm wondering if it's time to be looking at that.
I don't know. It's got let's pull it up. Market cap $58 billion, revenue $15 billion. So you're nearly 4 times. That's still a little steep. It's but for their net profit margin, which last quarter was 18%, that's okay. It's slightly on the high side, and but it does have a good dividend yield. And man, there's a whole lot of money in selling soap. Holy cow!
Oh yeah!
Look at their profits. Yeah, their gross profit margin this last quarter was 60%. That's That's amazing. So maybe we should get into the soap business, Jerry.
Okay, so one other one I kind of looking at, it's near its low point, Estee Lauder.
Yes.
EL is the symbol.
Okay. Oops. Let's pull it up here.
About a 2% dividend.
Yeah, Colgate-Palmolive actually had a 3.8% dividend, so that's not too bad.
No, it has a very nice dividend.
And by the way, I'm actually, now that you mentioned that, it's funny. That's been in and out of the dividend model over the years. So if it gets hit really hard, it'll probably be back in there again. It'll qualify again. So Estee Lauder, on the other hand, has $11 billion in revenue, 11.29, market cap or market value, $28 billion. For those of you that don't know what market cap is, it's basically the number of shares of the stock they have outstanding times its current share price. So it's what the whole company's stock is selling for today. Yeah, and so that's what we call the market capitalization. It's you just have to memorize that term. It means the value of the stock is about $28 billion for Estee Lauder. The revenue, $11.29 billion, means you're over about 2.5 times.
2.5 to 3. Yeah.
That's not bad. It's profit margins. Let's see what their averages were. Over the last year, it was 10%. Look at the last 5 years, average is right around 10%. So, and that's not surprising. Estee Lauder is kind of a premium brand, and got a lot of competitors in their industry. But so 10% is pretty good, though. Actually, that's very good. Net after tax, that's pretty huge. So I don't know. That's another one. It's right around where it should be. And at 97.50 back in April, I would have said, it's not that good of a deal.
A little steep, yeah.
So at this point in time, does it keep going? Well, now that the trend on the stock itself looks down, from earlier in the year, I think I would probably wait on that one too. Or that might be a decent stock to do covered calls on. I'm not sure I would sell puts, although that gets really complicated really fast. There's some things that you can do there, but most people don't have enough time to sit around and watch and follow it to make the adjustments they're going to need to make. So I really hesitate to talk about selling calls or puts anymore. It's too time consuming for even for people like me. I've got a lot of things going on during my working day. For me to have to pay that close attention to something like that, it's just not going to happen. So.
Yeah, no, they certainly require a fair amount of time. I got a couple oil companies here. Apache.
Okay, is that one APA?
APA, yeah, okay. You got it.
All right, let's see. Market cap, $24 billion. Revenue, $4.8 billion. Wow. That's a little steep.
Yeah, so, I was going to say, yeah.
From an investor standpoint, not interested. Just that quickly. If it were to come up on a trade, I might take it. Although I got to tell you, those really big companies like that, $24 billion, that stock's never going to run up 200-300% inside of 5 or 6 months. So,
sure.
Yeah. So I would probably not want to trade that one either. If for some reason it dropped down drastically, then I might be willing to look at it. And they are.
It's near its high right now.
Yeah. In 2008, this is interesting because, see, the price of oil has so much to do with their revenues and their basically their valuation. Businesses like that, unless it comes up as one of the stocks in one of the models that I run, I typically won't touch it.
Sure.
If it's super cyclical, you've got to get the economic cycle right. You've got to be accurate on it. Well, that's about 10 times harder than predicting when the Browns are going to win their next Super Bowl.
Yeah, forget about it. Okay, I got two healthcares, Abbott and Lilly.
Okay, Abbott is ABT, so I'll pull that one up. $20 billion revenue, $56 billion market cap. Again, right around where it should be. Nice, kind of nice dividend. The dividend yields like 2 3/4. Yeah. So, okay. If you really liked the company a lot, I think if you got a 10-year time horizon and you don't mind the stock going sideways for quite a while, then hey, cool.
Well, next year is supposed to be a fairly flat year, so at least that's what they're saying, unless you hit a home run with a specific stock. So perhaps something like that, or Lilly with covered calls might have some advantage, something with a decent dividend.
As long as you don't mind giving up your day job to babysit them.
All right.
Yeah. But what was the other one? Lilly?
Lilly, LLY.
And again, Lilly now $20 billion in revenue, an $80 billion market value. That's four times.
Yeah.
That's pushing the extreme. And so Abbott's the better of the two based on valuation. But that's just valuation. And you get into all kinds of other items. There are so many things. These big companies, when you've got billions and billions of dollars in revenue, that company is doing so many different things that it's incredibly difficult to get your arms around.
Sure.
And so if I'm going to be an investor, I want to be able to understand the business. That's why I typically, when I'm an investor, I invest in small companies that only have a couple of lines of business, 4 or 5 at the most, because they're too hard to understand. There are too many things that can go wrong when you have 50 divisions in your company.
As they say, too many moving parts.
Yeah. And, it's great. A lot of those businesses, if your time horizon is 10 years, you're happy with getting a 2.8% dividend, which is what Lilly's paying right now, and you think that it's going to do well, and you're willing to hang in there for an extremely long time period without expecting to make a whole lot, then I say, great, you've got the right temperament to make money with that. If that doesn't sound appealing to you, and I know it doesn't sound appealing to an awful lot of people, then there's a reason for that, because it's hard. If you're not 30 years old, it's tough to say, look, this thing sold at $59 in 2007, and it's only 73 in 2017. That's not a big gain. 14 points over that entire time period. That is that's not a huge gain.
Nominal, yeah.
Right. So, but it is better than zero, and it's better than
or losing. But that's not what we're here for.
Right. Yeah. And by the way, the first 2.5 years, well, actually almost 3 years, you would have been down under that stock, and it took you before you actually showed a profit in it, it would have been 7 years.
Oh, wow. Oh.
Now tell me how long of a long-term investor you are.
Yeah, that's much too long for my taste.
Yeah.
No. All righty. Thanks so much.
Hey, thanks for calling.
Take care.
Good weekend.
Yeah, bye-bye.
Yeah, I'm going to go right to Daryl. Daryl, you've been waiting patiently. Thanks for hanging in there.
Happy New Year, Bill.
Hey, how you doing?
I'm doing well, thank you. How about you?
Oh, pretty good. Just
You sound good. Sound good.
Thanks.
I was listening to you and Jerry, and the more I listen, the more thankful I am that I have you taking care of my investment with your great staff. You say that it's not complicated, but
well,
you two guys sure make it complicated.
Well, he's a more sophisticated investor, and he's got a lot of questions. But the reality is, it doesn't have to be that hard. So I had to learn all this stuff to be able to speak with people who were very sophisticated. There were an awful lot of money managers back in the day. In fact, Warren Buffett is he's as sophisticated as they come. And oftentimes he'll say something like intrinsic value, and everybody's scratching their head. What the heck does he mean by that? So once they've learned a lot of this stuff, they forget how to speak English. And the reality is, it doesn't need to be that complicated. If you've spent your entire life studying that stuff, and I know I talk over a lot of people's heads a lot of time because I have spent a lot of time doing this, but here's the reality. If I tell you, hey, look, here's a company that's earning 10% on the money that you would pay for that company, and here's a company that's paying 5% on the money that you would pay for that company, which one do you want?
Well, that's obvious.
Yeah, it's not a trick question. You want the 10%, so you got to get to that point. How do we know? And that's again, we'll cover it at the workshop, and I'll go through it again after the workshop on the radio in detail. But it's really not that complicated. it just doesn't work like people really want it to. But hey, I got to run. I hear the music. That means that my show's over. Sorry for.
Speak to Bill personally. You can call him at 330-664-0700. That's 330-664-0700. Or contact him through his website, bullingtoncapital.com. That's bullingtoncapital.com. Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.
The preceding program's views, claims, or representations may not reflect those of AM 1420 The Answer or Salem Media Group.